Amentum Holdings, ticker AMTM, delivered a massive bottom-line beat, but missed top-line consensus for its fiscal Q3 2026.
Right, and the revenue came in at $3.49 billion.
Yeah, which is down 2% year over year. So it missed that $3.57 billion to $3.6 billion Wall Street consensus.
It did, but on the bottom line, adjusted diluted EPS just crushed it at 67 cents.
Up 20% year over year.
Exactly, soaring right past the 40-cent estimate.
And then management updated their guidance. They actually lowered their full year 26 revenue expectations to between $13.8 billion and $13.95 billion.
But they raised the adjusted EBITDA guidance to between $1.115 billion and $1.14 billion.
Right, and they raised the adjusted EPS guidance to a range of 2.4 to 2.50. While, free cash flow guidance was just maintained at 525 to 575 million.
So after all that, how did the market reward this massive 67% EPS beat?
By instantly wiping out 8% of the company's value.
Yeah.
Shares completely gapped down in after hours, trading to around $22.39, and they eventually closed the following day, down roughly 3.8%.
Which, it sets up one of the most fascinating earnings anomalies we've really seen this quarter.
Yeah.
The equity market aggressively punished a stock for delivering record profitability.
Right.
So what we're doing in this deep dive is dissecting this tug of war happening inside Amentum right now. The company is experiencing the severe friction between a shrinking top line and rapidly expanding margins.
And investors are just struggling to figure out if they're looking at a business in decline or, a business successfully executing a massive structural pivot.
Well, we have to unpack the mechanics of that 2% revenue drop first.
Definitely.
Because a miss that sends a stock down 8% usually implies, evaporating customer demand.
Yeah, but when you look at the sources, that $3.49 billion revenue figure seems heavily distorted by corporate restructuring and accounting shifts. It's not just lost business.
Exactly. It is entirely structural. When you dig into the core drivers of that revenue contraction, the first major factor is Amentum navigating contract transitions from consolidated to unconsolidated joint ventures.
Wait, I want to pause on that for a second, because the accounting treatment there, it fundamentally changes how the top line looks to, an algorithm or a headline skimming investor.
Right, because when you consolidate a joint venture, you claim all the revenue on your income statement.
Yeah, but when you unconsolidate it,
you're only reporting your share of the net income on the bottom line.
Exactly. So the gross revenue just vanishes from the top line.
Even though the actual cash generation of the business hasn't fundamentally changed at all.
Right. And management is doing this intentionally, basically to shift risk off their balance sheet.
Yeah, it's a strategic move, but the optics are terrible for year-over-year revenue comparisons.
Oh, yeah.
And on top of that accounting shift, you've got natural program wind-downs and a 3% negative headwind purely from divestitures Amentum made in fiscal 2025.
Right, they literally sold off pieces of the business last year.
Yeah. Add in some extended contract protest periods and lower materials volume, and you get a top-line number that just looks weak on the surface.
But the reality is found further down the income statement.
Exactly.
Because despite bringing in less cash at the top line, their adjusted EBITDA actually grew 6% to $290 million.
Pushing their adjusted EBITDA margin to a record 8.3%.
Which is up 60 basis points year over year.
Yeah.
And in the government contracting space, an 8.3% margin is incredibly robust.
It's massive.
It tells me they are squeezing significantly more profit out of every single dollar of revenue they do bring in.
Right.
If I could put this into a real-world context for you, it's like a restaurant that intentionally served fewer customers.
Oh, okay.
But they made significantly more money per plate because they just dropped the cheap all-you-can-eat buffet.
And focused entirely on premium steaks.
Exactly. Premium steaks only. Total revenue drops because foot traffic drops, but the profit per table skyrockets.
Yeah, that transition from low-margin base operations to highly technical engineering, that's the core thesis management is pitching right now.
Yep.
In the government space, there is just an abundance of this cost-plus work. You essentially pass through the costs of providing a basic service to the government and attach a tiny fixed fee, like maybe 2% or 3%.
Right, which pumps up your reported revenue beautifully.
Oh, yeah, but it does absolutely nothing for your bottom line.
Yeah.
So Amentum is walking away from that base operations work and pivoting aggressively toward higher value, technology-enabled, fixed-price contracts.
because their specific engineering expertise allows them to capture much wider margins there.
Exactly.
But, okay, I have to stop you there and push back on this strategy a bit.
Sure.
Because we look at defense primes and federal contractors all the time in these deep dives.
We do.
And in this specific sector, overhead absorption is basically the name of the game. Scale is usually the ultimate moat.
That's true.
Those low-margin, cost-plus contracts, they're the safety net. They're the bread and butter that keeps the lights on, keeps your workforce employed, and
absorbs the massive corporate overhead during dry spells, yeah.
Right. So turning away guaranteed federal money to chase high-margin tech contracts, it seems incredibly risky when your top line is already shrinking.
It is risky.
I mean, is actively shedding revenue ever really a good idea in government contracting? Or is management just trying to put lipstick on a genuine top-line miss?
Well, listen, that is the defining risk of their current strategy, and it's exactly why the stock sold off. The market shares your exact skepticism.
Yeah.
If you shed too much of that low-margin revenue, you lose the scale required to absorb your fixed cost, and suddenly those high margins just collapse inward.
Exactly.
But let's look at the actual numbers to see if management's bet is actually working. The clearest example of this margin over volume strategy in action is their Global Engineering Solutions segment, or GES.
Right.
In the third quarter, GES revenue fell by 5%, dropping down to $2.033 billion.
Yet their adjusted EBITDA for that exact same segment rose 9% to $174 million.
Right. Revenue down 5%, profit up 9%.
Wow.
It proves they aren't just spinning a narrative to cover for lost bids, you know. By exiting that less profitable cost-plus work, they are materially doing more with less.
So they're proving they can be a leaner operator without losing their pricing power on the technical side.
Exactly. Meanwhile, their other major segment, Digital Solutions, showed a much more traditional growth profile.
Right, I saw it.
Revenue there increased 3% to $1.457 billion, and adjusted EBITDA rose 2% to $116 million.
Okay, so GES is basically taking the intentional revenue hits to drive the profitability narrative.
Yeah.
While Digital Solutions is providing steady, albeit slow, top-line growth.
Exactly. And the downstream effect of this profitability is showing up directly on the balance sheet.
Right.
Because they're generating stronger cash flows from these higher margin contracts, they are aggressively deleveraging. Amentum paid down $125 million in debt just this quarter.
Which brings their 12-month total to nearly $700 million in debt reduction.
Yeah, which creates a really powerful financial flywheel.
Oh, for sure. Especially in a higher interest rate environment, retiring $700 million in debt removes a massive interest expense burden from the income statement.
Absolutely.
And that savings drops straight to the bottom line, which artificially inflates that 67% EPS beat even further.
Yep.
I mean, it's a brilliant financial engineering move while they wait for the top-line growth to return.
And management explicitly stated they're pushing toward a target net leverage of less than 3.0x by the end of fiscal 2026.
Right.
If they hit that, they open up massive optionality for share buybacks or targeted acquisitions.
Okay, so the deleveraging is great and the margin expansion is impressive, but you could only cut low-margin work for so long before you literally hit boom.
Yeah, that's fair.
Eventually, you cannot shrink your way to long-term greatness. To justify a higher multiple, Amentum actually needs to sell more services. So where is the actual growth supposed to come from?
Well, we have to look at the $48 billion elephant in the room.
Right, the backlog.
Exactly. Amentum's contract pipeline and their targeting of specific emerging catalyst sectors, that tells the story of where they expect this growth to materialize.
Okay.
They ended Q3 with a total backlog of $48.2 billion.
Wow.
That's an 8% increase year over year, driven by $17.7 billion in trailing 12-month net bookings.
And they have a book-to-bill ratio sitting at a very healthy 1.3x.
Yeah.
Meaning they're basically stacking up future work 30% faster than they are burning through their current backlog.
Exactly. And management also noted that 92% of their preliminary FY27 revenue is expected to come from existing or follow-on work.
Which gives them incredible visibility.
It really does. Plus, there's another $32 billion in pending awards just waiting in the wings.
But if you want to understand the long-term moat they're building, you really have to look at the composition of that backlog.
Oh, absolutely.
They're positioning themselves in high-growth, technology-intensive sectors where the barrier to entry is basically insurmountable for a standard IT contractor.
Yeah.
And two massive catalysts stand out right now in the sources: nuclear energy and AI digital infrastructure.
Right. The nuclear energy piece alone is already a $2 billion annual revenue generator for Amentum.
That's huge.
Yeah, they've secured partnerships with massive players like Westinghouse and Rolls-Royce for new nuclear capacity.
Because designing, deploying, and remediating nuclear power, that requires decades of specialized, highly regulated expertise.
You can't just pivot into nuclear engineering.
No, definitely not. The compliant frameworks, the security clearances, the institutional knowledge required to safely manage radioactive materials.
It creates a competitive moat that isolates Amentum from standard federal bidding wars.
Exactly. And when you combine that nuclear expertise with the AI and digital infrastructure piece, you get something genuinely groundbreaking.
Yeah, tell them about the data centers.
So they're currently scaling with hyperscalers, the massive tech companies building out the cloud for data center engineering. Management highlighted an initiative at the Savannah River site that completely reframes how we should look at this company.
Right.
They're combining nuclear power generation directly with AI data centers. We're talking about a project that could resemble a 2-gigawatt nuclear facility, generating over $1 billion in revenue for Amentum over its life.
And this is the critical mechanism the market might be completely overlooking right now.
Yeah.
If you follow the broader tech space, you know the absolute biggest bottleneck for AI development right now is not the chips, and it's not the algorithms.
It's power.
It's power, exactly. AI data centers are incredibly power hungry, and they require massive, uninterrupted baseline electricity.
Right, because renewable sources like wind and solar, they just cannot provide the consistent 247 load required to keep tens of thousands of GPUs running without grid failure.
And the hyperscalers are realizing they essentially have to become energy companies if they want to keep building data centers.
But tech companies do not know how to navigate the Nuclear Regulatory Commission.
No, they don't.
They don't know how to handle the specialized cooling requirements of a nuclear reactor, or how to engineer the complex grid interconnects.
But Amentum does.
Exactly. They sit perfectly at the intersection of designing the nuclear power source and engineering the complex digital infrastructure that connects to it.
It's a brilliant strategic position. I mean, if you can solve the AI power bottleneck, you essentially have a blank check from the hyperscalers.
Yeah, but I'm going to bring us back down to reality for a second.
Uh-oh.
Because management mentioned something earlier that gives investors massive anxiety. Protest purgatory.
Oh, yeah. That's a big one.
They admitted that $175 million of FY26 revenue is currently delayed because competitors are protesting the contract awards.
Yeah.
If that much money is just sitting in legal limbo, isn't a $48 billion backlog just a mirage? I mean, winning the bid is meaningless if you can't legally start the work and recognize the sales.
Look, it is the shadow hanging over every major defense contractor. In the world of massive government procurement, whenever a huge multi-billion-dollar award is handed out, the losing bidders almost always file a formal protest with the Government Accountability Office.
The GAO.
Right. It's just a standard weaponization of the procurement process. The logic is simple. If you lose a huge contract, you file a protest to force a reevaluation.
Hoping to either win it back or at least delay your competitor from gaining an advantage.
Exactly. But the immediate mechanism of that protest is an automatic stop work order.
Right. Everything just freezes.
Everything. No work is performed, no costs are billed, no revenue is recognized.
Which is why the market is heavily discounting Amentum's $48 billion backlog. Investors are looking at that number and demanding proof of execution.
Yeah, the burden is entirely on Amentum's management to demonstrate they can successfully navigate the GAO protest process.
Right. Finalize the contracts and actually monetize these awards on a predictable timeline.
Until they prove they can convert backlog into cash flow without endless delays, that top-line revenue number is going to remain sluggish.
And since the market is clearly in a show-me state regarding that backlog, we need to lay out the immediate risks keeping the stock price depressed.
Right.
And then look at what the current valuation setup means for you, the listener. Because protests aren't the only thing dragging on the top line. Management also warned of a roughly 3% headwind for fiscal 2027, resulting specifically from NASA insourcing initiatives.
Yeah, insourcing is a cyclical risk inherent to government work. Political winds change, agency budgets shift, and suddenly a federal agency like NASA decides they want to build internal capabilities rather than relying entirely on contractors.
Right.
They pull the work in-house to retain institutional knowledge, and that revenue simply vanishes from Amentum's pipeline.
And when you combine that 3% NASA headwind with the 1% headwind from their intentional exit of low-margin work,
you get a very muted preliminary outlook for fiscal 2027.
Yeah. Management is pointing to reported revenue growth of essentially 0 to 1% for next year.
Wow.
I mean, if you're looking at 0 to 1% growth, you're probably wondering why you shouldn't just put your money in a treasury bill and go to sleep.
And the market certainly panicked. That guidance prompted serious analyst caution, with firms like BT lowering their price target down to $30.
Yeah.
When your top line is flatlining, growth investors hit the exits, regardless of how pristine your margins are.
But this is where the valuation setup becomes really compelling for a specific type of investor. Because despite the headwinds, Amentum is currently trading at an EV to EBITDA multiple of approximately 8.5x.
And to put that 8.5x multiple in context, your standard large cap defense prime, the companies providing the traditional overhead and scale you mentioned earlier,
Right.
they typically trade anywhere from 12x to 15x EV to EBITDA. The market is pricing Amentum at a severe discount to its peers.
So let's contextualize that discount with some hard modeling. A valuation model provided by TIKR looked at Amentum using very conservative, almost pessimistic assumptions. The model assumed just a 3% annual revenue growth, basically acknowledging the slow top-line reality.
Right.
And a modest 6% operating margin. Based on those highly achievable metrics, the model suggests a fair value for Amentum around $35 per share.
Which highlights the disconnect. The stock was recently trading near $22.
Yeah, that implies roughly 55% upside from current trading levels just to reach a baseline fair value.
Synthesizing this entire setup, the conclusion is that the equity market appears to be severely penalizing Amentum for temporary transition timing issues.
Yeah.
The stock is being punished because GAO protests are delaying immediate revenue and because management is intentionally shredding low-margin contracts to fix the foundation of the business.
So it all comes back to whether you believe they can survive the transition. Can they shrink the low-margin base operations business and survive the NASA insourcing hits long enough for the high-margin nuclear and AI projects to actually materialize on the income statement?
Well, for value-oriented investors who prioritize cash flow generation, margin expansion, and deep backlog visibility over immediate top-line spikes, the current 8.5x multiple presents a highly compelling entry point.
Right.
But you have to be willing to stomach the short-term noise. Management has built the $48 billion backlog. Now they just need to execute it.
So what does this all mean for you? I want to leave you with a final thought to ponder.
Go for it.
The market is currently obsessed with this quarter's contract delays and the immediate NASA headwinds. But take a step back and look at Amentum's truly unique positioning at the intersection of nuclear energy and AI data centers.
Yeah, it's a completely different perspective.
We are entering an era where access to massive, stable electricity is the singular bottleneck for the future of artificial intelligence.
Right.
If Amentum successfully proves they can concurrently engineer the nuclear power grid of the future and the complex digital infrastructure that demands it, are they building a structural technological moat that traditional government contractors simply cannot match? It really is a question of short-term pain for long-term dominance.
It's going to be fascinating to watch.
Definitely. Make sure you follow the show for your daily no-fluff earnings deep dives. Catch you next time.